one of the things that we've been talking about with the first two presentations that I did was how to use the sector leaders, and then my weekend routine, and I hinted at how I track the mutual fund activity. So one of the things that after our last meeting, Sam and I were talking about how I'm really finding interesting tidbits in the mutual fund report as I understand and learn more about what the status of the market is. And that's one of the things Sam challenged me with. Okay, then put something together to show you how to use the mutual fund report to go do this. So that's what I put together today. So in order to find your stocks, one of the things that William O'Neill always said, you have to be in sync with the market. So you don't want to be investing unless you understand what the market is. So that's part of CanSlim. That's the number one focus. That's them. So CanSlim is the investing technique, and each letter stands for something. Well, the M in CanSlim is market. So understanding what the market environment is critical. So on IBD's website, you have on the far left side, you have the IBD market trend tools. So if you click on that, you have access to the big picture, which summarizes. This is not there. This is something that I told you to pay attention to, and just know where if you're investing in growth stocks, the NASDAQ composite is the index you want to follow. And your key is know where the composite is with respect to the 21-day moving average. The high-low ratio, this is basically new highs that are being made in the market versus the new lows that are made in the market. On the psychology side of things, when you go to market trend tools, those 5 psychologies, if you page down, will be summarized on the raw data for the day's close will be down that right-hand column. Two of the critical things, in addition to the put-call ratio that we refer to, is the high-low ratio. When we're in an uptrend, this IBD's high-low ratio will be pegged at 2.0. When that's pegged at 2.0, it's important. You're in a growth environment. Unfortunately, they don't give you the raw data when you look at that chart. But on a daily basis, if you keep a market journal, you can get that. And that's in the later on slide. But the best thing that they put together is this volatility chart. When you start understanding the volatility in their little paragraph that goes along with their definition, you guys, you follow that, you know where you're at. Period. End of story. You don't argue with the market. You get on the right side of things. Okay? And I'll show you how to do that. So next. Oh. So I'm calling this part 1 and part 2. Part 1 is the big picture and the NASDAQ composite. So every day in the big picture, it's going to give you the status of we're in a confirmed uptrend. The uptrend's under pressure, correction. Well, if we're in an uptrend, the composite's going to be above the 21-day moving average by more than 1%. It stays above 1%. When the market's under pressure, it's in a very tight trading range, and it'll be basically oscillating plus or minus 2% around that moving average. When we're in a correction, it's below the 1%, 21 moving average. And until it gets back into this trading range, you guys are swimming against the market if you're trying to make a lot of money and progress when the composite's trading below the 21 EMA by more than 1%. From October 24th to November 4th, it was painful if you were 100% invested. And now most of that has been rebounded since the November 8th election. In the back, I have a stock tip for you, is to use the free site, stockcharts.com, make a chart, bookmark it, so that you can reference it on your computer every day. And it's basically, it puts that 1% envelope, plus or minus, around the 21 EMA. And I show you how to do that. And it's plain and simple. If it's above that 1% window, we're in an uptrend. Guys, it's above the 1% envelope window, we're in an uptrend right now. Okay? Part 2 is the psychological tools on the high-low chart. So confirmed uptrend, or when the uptrend is under pressure, the IBD will be pegged at 2.0. It doesn't deviate off 2.0 until you're in the final leg of the market going down. So in other words, when you're in a correction, that the first 2 waves of the selling where the mutual funds got out of Dodge, this ratio is pegged at 2.0. So if you're waiting for it to deviate off 2.0, you've already taken some damage. But that day that it comes off 2.0, you need to have stops in place on everything you own. You need to ask yourself, do I want to lose 3% or more where it is today based on that? And if you don't care, then you don't put a stop in. If you care, define your risk. Get your risk captured, because we're going down. It doesn't go 1.98 to 2.0. I've gone back and looked at it, and it doesn't do it. It might do it for about 10 days, and it literally was about 10 days from October 25th to November 8th or 7th when it bottomed. So a tip on this, what I'm telling you to do is start a market journal. Summarize some of these facts. One of the things that you want to do every day is go find out what that high-low ratio was. In other words, what the raw data is. And we'll show you where to find that. So yesterday it closed at 3.37, which is it's been increasing since November 5th, or November 7th, Monday. Every day since it ticked back above 0.5, it's been going up by 7% every day. That's an uptrend. When they are no longer making new highs on the growth stocks, or new lows on the growth stocks, and the buying pressure is continuing to put that ratio high, it's a market uptrend. So that's one of the things I do. So it will peak. I told you in one of those presentations about the sector leaders, how the sector leaders will kind of sometimes pause at 12 or 13. Well, guess what? The sector leaders, literally about a week after we left that meeting, peaked at 12 and 13 for about 4 days. That was 5 days after this high-low ratio peaked. And from that day on, that high-low ratio, until it went to 0.47 or 0.48 on November 4th, was in a downtrend. From September, October to November 4th, the high-low ratio was in a downtrend, which means the leaders of the past market uptrend were being sold off. So if you're expecting Facebook, Amazon, Google, Bang, all these, they were being sold off. The market was in a correction. All those stocks were heading towards their 200-day moving average after being in firm uptrends, which was well above the 10-day moving average, well above the 21-day moving average, well above the 50. And now they were breaking down, going to the 200. You're not going to make money if that's how you're investing, okay? So the buying pressure accumulation means the ratio is increasing. And it bottomed on November 8th, the election day. It bottomed when Kyle Icahn put $1 billion into the futures and stabilized the market at around midnight of the election night, when he was informed on a live interview. If you guys were watching the market during that time, it was priceless. Because it was from 8 o'clock when the first positive note that Hillary is in trouble until 11:42, the futures just were spiking down. The Dow was going down 1,000 points. It was fun to watch. Now, if you were very long like I was, I didn't care. I saw that Trump was going to win, and when it started going up, it was fun. But I'll show you where I made mistakes, and it was basically, I misinterpreted that. You misinterpreted that, you're going to lose. And I'm going to show you how to correct that, and how to protect yourself once you do that. So at bottom, and the article says that first uptick, when it goes below, and I'll give the definition here in a minute, but that first uptick went up 24% on the day after the election. It went up another 20%. Guess what was under accumulation on November 4th, 7th, 8th, 9th? Small caps, mid caps. We had a very powerful follow-through day in the mid cap arena, the small cap arena, and the the Russell 2K. The paper did not call it that. In the 90s, the paper called it because the small cap index was on the markets page along with the S&P 500, the composite, and the New York Stock Exchange composite.
By the way, the IBD tip poll was the only one that predicted Trump victory.
Yes.
That was the only poll that ever predicted.
And the reason why I stayed long, and I know you and I were arguing this, the IBD tip poll on Friday said Trump's winning.
Right.
They haven't missed an election yet.
What website did you watch that on?
I was on Fox Business because Fox has been
Fox,
the only
right.
one
You were just
that...
listening to it.
Huh?
You were just listening to it. You weren't watching the market.
I was watching... I was staring at the TV.
Okay.
I was primarily watching, but I was flipping back to... For entertainment value, seeing CNN cry,
Right, yeah.
seeing MBS, NBC cry, and seeing those guys in panic,
Yeah. That's
you
amazing.
can't make this shit up. So that night, guess what was present? From the, if you follow the market, you'll understand turns happen with the lunar cycle.
Oh, yeah.
But there was a huge
moon.
There was a huge super
Moon.
new moon out that night. Closest to the America since what other time? 1948. The last time the media missed an election.
1948.
Because the papers printed, Dewey wins the election.
Right.
You want to know how many Newsweek magazines were shipped with that glorious picture of Hillary Clinton winning Madam President?
Really?
That were shipped at all the bookstores, ready to go on the shelves on Tuesday morning? That was a...
Really?
Yes.
It's a collector's item.
Yeah. So, pay attention to the full moon cycles. You get humor. And sometimes it can make you money. But the IBD tip poll is why I stayed long, because I mean, if you guys think with Hillary Clinton and all of her tweets about the biotech stocks being killed every time she opened her mouth, we were going to go up in the healthcare arena, and Obamacare with all the premiums going up, you're kidding yourself. All right, so the high-low ratio, the definition, that's on that website. You guys got to understand this. In February, we had a, what I'm calling the bottom. And we'll look at the charts to show you. So on that follow-through day coming out of February, that put us back in a bull uptrend. Let me wait until everybody gets settled a little bit. So what you're looking at is this flag rebounds an intermediate correction during bull markets. So you were in a bull market because you had a follow-through day back in March. Okay? And by the way, the mid caps and the small caps, I know the big caps only corrected 3 to 4%. But the mid caps and all them, they corrected 8 to 12%, which is an intermediate correction. And when those that are doing the intermediate correction then do the powerful follow-through day, you pay attention. So the high-low indicator is a ratio of the new highs to new lows when the indicator first shows the first update after crossing below 0.5. November 4th, November 3rd, it dropped below 0.5. At 0.489 and 0.475 or whatever the numbers are. But essentially you had 2 days at 0.48 and then you spiked above. And that first day after crossing below, you look for a short-term bottom. And that basically can give you the sign that the bull market's resuming. This indicator is less useful for the markets in September or for the S&P and the NASDAQ when they're below the 200-day. Then it's 0.1. And the reason why that's important, if you look at that definition, it says a bear market. January, February, you fell below 0.1. The indices were well below the 200-day moving average. Guys, that was the end of the bear market. We had a bear market from May 2015 to July when we made the new all-time high of 2016. And if you don't think it was a bear market and everybody's saying the bull market's long in the tooth, the biotechs corrected 50%. The transportation's corrected 40%. Oil's corrected 70%. A lot of the oil names have corrected 90%. The small caps, mid caps all corrected between 25 to 28%.
Commodities, they also went down quite a bit.
Well, the energy, oil. So we peaked on 8.1, and I told you pay attention when we're at 13. We were at 13, 8.2, 8.3, and 8.4. And on those 3 days, the high-low ratio, if you were watching the raw data, was decreasing. How you could have done this, I'll show you a different way after this, how you can use the high-low table to collect the data on your own to track it. I do that as well, and they both confirmed the same day. We declined from 8.1 until 11.8. The sector leaders dropped to 4 on 11.11. I have been pegged at 4 sector leaders since then. And typically the sector leaders will either bottom at 0, 1, 2. They will go to 0 or 1 during the bear market. During the intermediate corrections, they will go to 1 to 4 depending on the severity. Those 4 stocks are growth names. They're a bank. They're a chip. There's a infrastructure internet. What's the other one?
Semiconductor, you say that, right?
I said the semiconductor. There's the GEMO,
Western Alliance Bank.
the bank,
How about steel?
GEMO is one. What's that? ESNT.
Yes.
and the health,
Insurance.
the property insurance provider.
But I'm surprised there's not more. I mean, it's been quite a run-up since the election.
In the
Well,
small
small
caps and
caps.
big caps, or mid caps. They don't
You
qualify.
are in the early stages. Keep in mind, this, I don't know what the sector, this was all developed after 2008.
Right.
So they didn't develop it during a secular bull takeoff phase. They didn't have it in place during, well, I guess they had it in place in 2009. So it takes some while. But one of the things that I've noticed that the sector leaders is not going to help you initially. for picking the right stocks. You gotta use the mutual fund
Right.
reports to understand where the trends are going. So the sector rotation of the past leaders, sub the buying. So if you were watching the high-low site on the every day when everybody's complaining about the volume, the buy side was pegged with stocks on high volume. The sell side was pegged on stocks on high volume. The stuff that was selling off was the utilities, the dividend plays, like crazy. It was carnage. But guess what? If you were looking at the mutual fund reports, and I'm putting this together in hindsight, so I wasn't proactive on this. I have lost a lot of money. I'm in the process of getting it all back.
Yeah.
But if I understood what I'm telling you tonight, I would have made a lot of money ever since the bull ended. Because one, I would have known when to be short the ETFs on the indices. In other words, if you want to, when that high-low deviates from 2, that's the time you go buy a short ETF. That is the ultimate signal for you to go short the market. And one of the ways that you can do this is you find which one's the weakest and you go pound it. And how you do that is you have a relative strength line with a total stock market index. IYLY is a good mutual fund to use for your relative strength. So whichever one has a more downward protraction, small caps or mid caps, because they corrected 12%, NASDAQ and S&P only corrected 4%. It was hard to make money if you were shorting the big caps. But if you were shorting TZA or the VIX, put it this way, I'll show you when you get long the VIX short products, because it tells you when to get long the VIX on here too. But the high-low ratio was basically, or the high-low money flow was telling you we have sector rotation going. And you could just see there was no comp rated 90 or above. It was all stuff coming from the bottom, moving, their industry groups were moving up the ranks. That's where, when we're in a correction, you guys need to go pay attention to the weekend paper and go study which of the industry groups are moving compared to 3 weeks, 4 weeks, whatever. So the high-low ratio back on this day, this was around, was the first 24th down to November 7th. I think if you put the, oh no you can't. So it came down to 0.5. Look what it did back in January.
Lower.
It came down below the 0.1 right here. Basically it got around 0.07, or that was 0.05 and that was 0.07. But this was the follow-through day coming off the February low, and you rallied until you ran into trouble in May and the Brexit. Then you had a strong rally until the selling started changing right here. And then you had the dramatic change right there, and then we're off to the races. The key to understanding whether this is going to fail or not is when you come back up above 0.5, you want to see 10% increases in that every day. You want to see the mutual funds continuing to buy. If you see it hesitate below 10% moves, and it does a turn like that, you have stops in place. If you see that hook down, you have stop in place because you're wrong. You got another leg coming. I thought this was the 3 waves of selling. This is not. The VIX is where you find the 3 waves of selling. Okay?
It can't go above 2. This cannot go above 2.
Right now, this is at 3.38.
Oh,
Well,
I see. It's
this-
not-
They peg it at 2. They are using a smoothing moving average. And I figured that out. And I too have a smoothing moving average. What I'm doing is using the data report for the high-low that's reported. You know that section that shows the high-low report? And it gives you the numbers for the NASDAQ, the New York Stock Exchange, and the AMEX. I add the highs from those three, I add the lows, and then I trend that, and then I take a 13-day moving average. You do the 13 moving average divided by the 13 moving average, you get this ratio. That's complicated, but they don't give you the math that shows this. So now every day I'm writing down what this raw value is. You only get one 24-hour period to pick that number up. Because once you're pegged at 2.0, it says 2.0.
And so you're looking for rate of change for the direction change, right?
So up here, it was north, well north, 5, 6, I don't know. I didn't catch on to it until it was in a downtrend. I started looking, well, son of a bitch, that's going down. So then I went and found all my past data, and I started finding a ratio that matched this at the turns.
So this is ratio of new highs to new lows?
That's all that is.
Right.
But it's using, I don't know what their raw data is. It's there per tired. It's there
On a
for
daily-
you.
On a daily basis.
Yeah, they calculated.
The other way that I've always done this, a simpler way, that's not, no charts or nothing, just look at the New York and the NASDAQ new highs and new lows. And if it's not over 40 on the new lows, this is probably pegged at 20 at the 2. If you've got 3 times the number of new highs to the new lows, and it's below 40 on either one of those two, we're probably in an uptrend. When that spikes up to like 60 or 80, we're probably in started into a correction. When those exceed the new lows exceed the new highs, this thing's coming down.
Well, I can tell you, using the paper summary and my moving average, this was in a downtrend. My 13 divided by the 13 moving average was in a downtrend. It was in an uptrend. It started going in a downtrend about right there. It started going in a downtrend about right there. It started going in a downtrend about right there. Guess what? The sector leaders peaked about right there. So when the sector, like I said, when the sector leaders get to 12, 13, you start paying attention to this chart. Because you're getting long in the tooth. A pullback's needed. You want to monitor that pullback.
So Dave, now the sector lead is nowhere close to 11 or 13. It's I think what, 5 or
Four.
6? 4. So you're saying this is still early in the innings?
I'm
Yeah.
telling you, well,
You feel
go back. That's the bottom. Here's your bear market bottom.
right.
This was inning 0. Opening pitch, play ball. We're screaming to the 2.0.
Got it.
You got a follow-through day. This is your first inning. This is your small correction to counteract that. You take off again. So this is an impulse wave. What I think, if we're off to the races, like the A's and E's are telling you on the IBD 6000, you're about to see one hell of an explosion take off.
Amazing.
Okay? So yeah, we're in the early innings. And the sector rotation has reset. The sector leaders has reset. So if a new one comes up, you go to that and you pay attention to that first stock that shows up, you buy it. Or you find a way to get into it. So part 2 is the volatility index. It's a technical sentiment indicator that helps determine the major market bottoms as well as the short-term swings. It is the market volatility index estimated based on the S&P 500 option prices, commonality known as the VIX. So they're just using the S&P VIX on this. So what they're basically doing, when fear rules the day, it's usually meaning you're near a bottom. So the volatility index will rise 20% above its 10 moving average. So what they're plotting, go to the next chart. So this green line right here is the 10-day moving average. The red line's the 50-day moving average. And they basically, if you listen to the financial channels, they're saying you want to get out of Dodge anytime it gets below 13. Well, guys, it can stay below 13 for a long ass time. Okay? Don't worry about that. What you want to worry about is when the 10-day is above the 50-day, that's typically we're in an upswing. Which means the 10 days above the 50-day in the NASDAQ Composite and the S&P 500. This is an inverse. What this is basically showing you, in September, you see how we bottomed at 11.2 and we got very tight around the 10-day? That's when the sector leaders had started to roll over during this time. This is where the subtle buying or selling pressures start. When that starts upticking and you go above 20% above, that is basically signaling your first wave. And you want to count these in 3 waves. How you know it resets is anytime the market's at a new high, you're at 0. When the markets are at new high, you're at 0. And then you're counting sets of 3. Every time you know you're at 0, NASDAQ Composite hit a new all-time high today. You're at 0. Okay? So you're paying attention to this. You see this spike above 20%, that means the rally is going to come under pressure. You want to start, but that's just the first stage. It's going to jitter around. So this would, did anybody know? I mean, we had a meeting last time. Right here is when we're meeting. I didn't know we were in a, I was telling you to get long, right? I was getting long. When we met last time, I was 60%. By the time I got here, I was 100%. That was the stupidest thing I've ever done in my life. And I've done it here, 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 and here. So how you know to correct that is when you see this first arrow, print this out when you get home. Label this 3, 2, 1. 3, 2, 1. 3, 2, 1. Just print that chart out. This is the printed chart from the weekend. So you can see, you saw how the high-low never got above 1.0. You see how many times as soon as you got to 3, you basically failed. Well, you see how the 10-day keeps halting at the 50-day and then goes back up? Well, that's when you're doing an immediate right turn and the high-low curved down because the selling resumed. And a new set of 3 came about. A new set of 3 didn't come about until you had a powerful graph. I mean, you guys remember the metals? Still, all the metals just screamed. We had debates about that from this. This was a 30% move in the metals. I mean, there was a lot of money to be made if you knew what to look for. And by the way, the mutual fund report showed you that metals were a hot item back here. So all you're doing is paying attention to whenever you see a red arrow, you know that there's going to be 3 waves of selling and it's going to be hard. You're in a correction phase. Okay? IBD is not going to tell you we're in a correction. I will tell you that the NASDAQ Composite will be either below 1% above the 21-day, it will be in that training envelope, or it will be below. And I'll show you that on the chart that I provided later. But you guys understand what I'm saying? So November 4th. So what this is showing you, the arrow is marking the last day it was above 20%. And it's intraday. All you care about is what the close of the, you're paying attention to the 10-day moving average, and the paper and the site shows that, and I'll show you how to interpret what they're saying. It says it right there. You're basically near the volatility close at 12.24, and you're within 1% of the 10-day moving average. Okay? So that you're safe. But typically down here, these rallies in, when you go on the other side of the 10-day, it can be 10, 20, 30%. I can tell you that when it's below 13, it's not going to go too far below the 10-day moving average. It might go horizontal for a long time, and you can make a lot of money. If we're about to take off, this thing is just going to go drifting down. It's just going to hover and torment people. You're going to see that UVX fund, it's already done 2 reverse splits this year. You're going to see it reverse split about 4 more times. People are going to lose tons of money trading that. Stay away from it. The day that you want to trade that is the day this arrow shows up on the 3rd count. You get long UVX when you see that peg in the futures and you know it's going above, and then you get out when you see the market turn. Okay? So part 2, it basically, each red arrow is the last day of the VIX spike where it was 20% beyond, higher than the 10-day moving average. They come in threes. The first spike confirms the uptrend is ending. Basically, it's coming under pressure. Selling pressure eases when it goes back below 10-day. So when that first wave ends, you have a relief rally. That rally goes until you close above the 10-day moving average again. You want to be out of whatever you're trading on the long side. When you get back above that 10-day moving average, get out. The second spike happens when it closes above the 10-day. Then you have a quick relief rally. The damage in your portfolio is going to be when that third arrow shows up. And it's going to be very quick. This rally is usually, this can go 3 to 4 weeks. This rally is going to be like 1 to 3 days. Maybe 4 days. The last one was, it spiked low on October 13th. It ended on 10/24. And typically those fail at the 21-day moving averages on the composite. You fail to close, or you trade above and you can't close above the 21-day, and the selling resumes. So a second chart that I've set up for you. Set up a stockcharts.com bookmark permalink for a VIX chart. That VIX, 10-day moving average with a 20% envelope around it. So when you see the intraday spike above the 20, you know you got a signal. Okay? So
It's like a Bollinger Band.
yeah, but this is, the Bollinger Band doesn't tell you all the time. This tells you, the Bollinger Band can just open up and continue going down.
It's dynamic.
This tells you what that Bollinger Band is going to do. Okay? So if you go back and look at this chart and go back and look at your indices, you'll realize that if you tie this together with the Bollinger Bands, you can tell whether it's going to start doing a squeeze or it's widening.
Well, and your envelope is just a solid envelope. It just
It basically
follows the line.
it follows the
doesn't
10-day
widen
moving
the
average.
arrow. It just stays.
Yeah, I'll show you that here in a second. So that tells you where the market is. That tells you what the status is. So when you see that third day, or that third arrow, you're looking for a turn in the market. The high-low is going to give you the turn in the market. When that high-low goes above 0.5, that's your key. And it's going to go above 0.5 by 20%, at least 15%. And one of the indices is going to do a follow-through day within 3. And that's what happened. So on the mutual fund report, print this out every month, because you basically want to know what the stem is. All right? Hang on. So I'm basically keeping them just to understand the markets going forward. So on the website right now, you can go get the first 10 reports tonight. You can go print those out, and I would recommend you do that. The October summary is either going to be this weekend or next weekend. It's probably going to be next weekend, since you only got 2 days on Friday. They typically need 3 days to summarize it. So it'll probably be next weekend. review the stocks, and basically what you're wanting to do is look what industry groups on that chart are represented in multiples. Like, are there 3 semiconductor companies on there? What is the best semiconductor? This whole year is NVIDIA. So here's a tip. When you know you got a leader and you see a red arrow, go to your growth name. It's pulling into your buy point. If it's on low volume, you're basically looking at NVIDIA was priceless. Every arrow, the February low, it told you I'm at a double bottom. I'm going to break out. When it goes above the 30-week moving average, you buy NVIDIA. When the Brexit or May came, it basically moved into the 50-day moving average. You bought it. When the Brexit came, it moved into the 50-day moving average. You bought it. The 3 pullbacks in September, October, November, it just set up an ascending base because the first one overshot the 50-day, the second one came to the 50-day, the third one barely missed the 50-day. That is Qualcomm 1999 all over again. So that's my interpretation. I will be wrong if I see a VIX arrow show up here very quickly. But if we break out and go forward, the market will tell you. So when you print this out, you then got the stocklets from my weekend routine. The 2 favorite ones are the weekly review. And look at every one of those, because VEE, what's that? VEEV, what's the name of that?
Viva.
Viva. That has been on the mutual fund reports all this year, and right now it's going to be a sector leader, I'm pretty sure, when it just gets the industry group, when something supports it from its industry group. So that's one that was on there. So essentially what you're doing is looking for names, and then you're just using the IBD stock checkup to verify it's a leader. And what I mean by that is you want it to be the first or second in that group. And if it's not, if it's 5th or 9th, then you pay attention, okay, what's number 1? And you go look at it. You maintain a watch list from this 15, 20 stocks so that you see what's going on. But the routine, the sector leaders, the mutual fund reports, that will basically tell you what stocks are showing up in multiple places on where to go. NVIDIA was there all the time. The VIX spikes indicate buying opportunities. So the bear market had the final push January 15th, February 2nd, February 11th. January and February showed potential growth leaders. January had Alta. That was a sector leader that went gangbusters for 6 months, coming off the February and March low. Burlington and Ross. Guess what stocks are holding up right now from the retail? O'Neill says you want medical, you want retail. You had subtle buying of these when they were at the bottom of their stock chart. So that's why I'm saying get this book so that you look at the 30-week average. When you're seeing Ross and Burlington bottom at the 30-week moving average, you don't have to hold them for a long term. These provide, every one of those buying opportunities gave you a 15% trade when the market resumed. The February report started showing NVIDIA, and they weren't big buys. Keep in mind, the January and February, there was no buying on the mutual fund report. 0.1. 0.1 means $100,000. Somebody's buying $100,000 of stock. If it's one fund, it's telling you one mutual fund just bought $100,000 over the course of the days near the bottom, getting their position started. When it becomes 5 funds buying 300, like it did in February, for those stocks, you start paying attention. Strong rally from February to 426, that was your impulse rally off the bottom. You basically saw some themes start showing up. 3 industry groups started having representations by multiple companies in it. RB, Patrick, DW, Thor, WGO's been on there once. But Patrick and Thor have been littered on there all year. And now that I know what to look for in those small numbers, especially when we're in market declines, you go bottom fishing. So I use the 30, when we get back above the 30-week moving average, and again, the book that I'm basically using this premise is this book. You go understand this book and understand what a potential turnaround move of the story. When you get above the 30-week moving average and start bottoming, that's your opportunity. Okay? That was Thor. This stock, although it looks like it's kind of in a topping phase, has been on 7 of the 10 reports this year. Not much, but if you looked at it, if you were aware of that, you could have been buying it every time it touched the 10-day moving average. And then there's a company called Rock and a company called Worthington. Worthington's been in the top 10 of the IBD 50. Well, this showed up in February that it was bottoming as the metal fabrication. Rock and WOR were showing up. So then you have it take off. NVIDIA was the star of March. And it basically it broke out of its double bottom, whatever pattern you want to call the February low. Okay, and then your next 3 sets. So if you print out the charts, the last 9 arrows I basically summarize on these 3 phases. So VIX spike indicates pullback. The Brexit correction had 3 spikes. So if you remember, everybody was a tizzy starting in the middle of April. Brexit was coming up. And then you started seeing all the media polls interviewing everybody from London. That, are we voting out? Nobody was caring about the people outside London or the rest of the country. Their sample was, I'm sampling 100,000 people in London. I'm sampling 100,000 people in London. Nobody was going outside the country.
That's what happened here.
Yeah.
Exactly what happened here.
So April and June were in May were the reports you wanted. Well, guess what themes continue? Steel, and Steel Dynamics is probably the best company, but these 3 were featured all 3 times. Then heavy construction came, and then these 3 stars came, and metal fabrication. Rock has been in the stock spotlight all year. So when you see stocks that just hang out all year in that stock spotlight and you say, okay, I need to get some of that, go look at a VIX spike. It's screaming at you to go look at that chart. If it's at the 10-day moving average, the 21-day moving average, or the 50-day moving average, and it's on low volume, you buy it. Buy $1,000, see if it goes up. This stock, if you did that here and here, you would have had 25% trades. And guess what starts populating all over the place during these? You got the banks. Strong rally from July. Actually, it was sometime in the middle of August when it actually ended, depending on what indice you're looking at. But the July and August reports, and the July and August showed huge buying. So that was basically just confirming a lot of the things, but there was a lot of big cap names. Facebook was on there. I think I showed you that report. What you care about are the small cap names and mid cap names. So then we get into the media and the election fear. So September 9th, you fell 2.5%. That Monday you went up 2.3%. That Tuesday you went down 2.5%. And then it ended and you rallied. and then it died on around 10-11, and you came down on 10-13 when you finally spiked above 20%. That rally on the 14th died at the 21-day moving average on every index. A couple of them made it above, but the NASDAQ never got above. The September report showed Schwab, and another key that you guys need to look at, if you like a company on the mutual fund report, go see how many articles are written on it in IBD. Just do a news, go down and see how many featured articles. New America, if it's on the New America, you care about it. But the best financial bank or company for this decade, you're going to turn out, it's going to be Schwab. When the interest rates get to somewhere around 1.5%, this company is going to be minting money based on the assets they have under, that are based, just, when they're making money off the interest rates, guys, this company's printing money.
They made a lot of money from me, trading.
Hey, one of the things that when you go to the Schwab workshops that they're hinting, when the interest rates come back to normal, there's a good chance that you're going to see commissions go away from Schwab.
Well, right now, margin rate of interest is what, 4%, and they're borrowing at 1. I mean, how much more spread do you have?
No, I mean when they're making it on the loan side, the deposits. When you get that money making money, right now it's not making money.
It's making it because it's loaning me for margin.
Well, turn around. They send me I'm just saying, they send me an email saying every day, whatever you're holding long, lend them the securities and get the margin back on your side.
Exactly.
So you can cancel that margin by lending in the securities back. If they're sending me, they got it. If your Schwab comes, they're offering that to you on a daily basis. I'm getting the email every day.
For what stock are you getting that email? What particular stock?
They're sending me a generic message to say, do you want to lend your securities out? They're in search of securities.
So you don't have yours normally in a
shorts?
margin account?
I,
Because don't you, when you do that, you have the ability to borrow against it, aren't you?
no,
No, they want to borrow his stock, that's what they're saying.
I know, but I thought.
When you
that's-
sign
No.
the margin account, you're right on there. He's mostly trading on already.
Oh.
well, they don't care where it's at. It's not, you're not the one, you're not controlling it. When you get out of it, you lose rights to it, and they'll close the book on it and follow the certificate. They're just wanting to borrow that certificate from you, and they'll pay you money. Now the dividend, if you sign up for that, if it's a dividend stock, you don't get the dividend. Whoever shortened it gets the dividend. So,
Shorts always.
still was another confirmation if you guys were following copper. Copper bottomed at 2.0 around this time. October report shows these were the top two. And again, October was a bad month of mutual fund buying. But you had 60 million, or 60 there and 345. Guys, Netflix is in the cup and handle. It needs to be on your watch list. This company has reinvented itself 4 times since 2003. This is the most innovative company we've seen in our lifetime. Pay attention to it. So, and that is a stock that needs to be on your watch list. Construction, again, steel, and that's where Steel Dynamics comes up. Powerful follow-through day on the day after election in these 3 indices. And they were already up 3 days going into that. So this was day 4. And by the way, they had 10th and 11th, they did 2 more follow-through days. And yet, what's the big picture saying right now? We're in a confirmed uptrend, but all those distribution days are still attached because the NASDAQ and the S&P never gave the follow-through day. Okay? They never, that's what they're using, and they're wrong.
It's a stealth rally. I mean,
Now, one of the things that happens, Wednesday, Thursday, and Friday distribution days start rolling off because it's 5 weeks starting Wednesday. And here's if you don't believe this statement, you need to believe this statement. I've told you over the last 2 years, every time the A's hit 800, you need to be fearing, because we had this long-term downtrend line of the A's from 2000 top of around 2200. Every rally was contained by that line. And by the time we got to 2014, that was 800. Well, guess what happened in the follow-through day in February? We screened to 1,000, 1,200 in that range. That was your breakout. This correction just tested that breakout. When you have a long-term downtrend line of 15 years, 16 years, and you break out powerfully, what happens? You come down and test it. 300 was the low in the A's on November 4th, which means, and guess what? That's coming down right to that downturn line. Okay? The last time we were here was the third peak off of the 2002-2003 bubble. So if we continue to see this screen higher, you know we're in a rally. And the reason why this can is because the other thing, when this started, the distribution was not a bell curve like it has been during this whole past. It's typically skewed depending on which side, bullish or bearish, but it was 1A, 2 B's, 1 C, 1 D, 1 E. I've never seen it like that. And it stayed that way for 3 weeks. And now all of a sudden it's moving that way, which means it's skewing towards a very bullish, because all those E's and D's are now starting to move this way. And the only thing that's going to be left in the D and the E column are going to be your utilities, the dividends, and all those other things that have been left for dead. That is the biggest bullish thing I've seen. And then you got another mutual fund report. This is probably going to give you hints of what are going to be the sector leaders when you compare the ones with the best fundamentals that have been on the other mutual fund reports. Okay? So I've attached 3 things that I want to go through. The October mutual fund report, the stock charts for the NASDAQ Composite and the VIX. And just again, if you didn't catch my commentary a minute ago, final thought. When you have a big leader, NVIDIA is winning in 5 phases of innovation right now. If you look, not 1, not 2, 3, there are 5. Go look at all the articles on IBD's website. This is the Intel of the Wintel connection of 1999. This is your Intel of 1999.
so if you miss this, you still get it at the buy point,
It was at its 10-day moving average today.
at standing.
It just had a powerful breakout from earnings. It just broke out of an ascending base. Force your way in. So when you are seeing pullbacks, so the VIX closed yesterday above the 10-day, you basically go look at, when it closes above the 10-day, that's basically telling you pullbacks in force. You go put some buy opportunities in on NVIDIA. So what I did, I
made a lot of money.
put it in at the 9-day moving average. I used the 4 and the 9-day. So you basically go look at a 60-minute chart with that set up, and it shows you where the pullback. Intel spent about 20 seconds at 92.60 this morning at the 9-day moving average. There was 1 million buy orders in. The volume spike was tremendous, and I sold it when it went outside the Bollinger Band last week, and got back in the position for a 5% delta of that trade. So my position is reestablished, and I'm
Okay.
But on every spike, like I said, it told you when the February breakout was coming. It told you the first test of the 50-day, the second test of the 50-day, and then what I'm calling, it broke out of a, well, look at the chart and I'll show you. So one of the things that you want to look for is heavy construction. You just go down, there's the sector leader, semiconductor, NVIDIA. I don't really care about how much this is because that's $60 million being invested over 21 days. So divide that and you see that's a lot of buying, and basically it's going to be subtle buying. Look how many funds are in. So 12 funds are still adding. So here's the sector. It's only 2 stocks or 2 companies buying, but still that's $1 million worth of stock that's being accumulated when we're in a pullback. And look at all the banks. So the other thing, there's Netflix companion. So Netflix over here at 345 somewhere,
Wow, they're buying huge.
right there. So when you see a second company that's supporting it, it tells you, okay, go study that chart pattern and see what's going on. It was a weird cup. You're pulling back. It's setting up the handle, so it's going to be breaking out soon. But when you basically, this tells you need to be doing something in banks. Finance, banks, heavy construction, MLM is somewhere here. But Worthington and Rock, and keep in mind these are small cap companies. Small cap money is, they're going to be subtly buying, or they're moving the price too much. They're wanting to accumulate their position at the same price. So they got to do it day over day. So the stocks are going to be, they're going to be doing it during bottoming action. Akamai, Internet, 5 networks, and then GEMO's somewhere around here. So you see how these themes are showing up? So GEMO is a sector leader, or was a sector leader. But if you, GEMO's been on the chart all year, okay? So what you want, it's just a way to get ideas, okay? But one of the things that I definitely do on the big caps, there's an MLM. So that's been a theme all along. I don't know how to go pick the best bank because there's no earnings. They're all turnaround stories and you're waiting for interest rates. So the best thing I know to do, just go buy KBR or KBE. It's the bank equal weighted fund. It basically has a basket of 40 of the banks. It's got a dividend that pays you, and you basically buy it when it pulls into the 21 or the 10-day moving average.
It's an ETF?
Yeah. If you want the regionals, KRE. XLF is not an equal weighted fund. It's basically Berkshire Hathaway. You want Berkshire Hathaway, go buy Berkshire Hathaway. It's 15% of the
One
position.
stock with the bigger banks, Citibank, that type of thing.
So like the oils, you don't want to buy XLE because it's Exxon. Buy XOP. It's an equal weighted fund. You want to buy the equal weighted fund.
Which is the better of the two, KBE or KRE? Which is the more reflective of what's happening?
Well, they're both going to win because they're both banks. The one's the regional banks, so those are the small and mid caps. The other one is going to be large cap and mid caps. So it's whether you like Goldman, Bank of America. So Schwab's in it, CFG. CFG is one of the big winners, and it's been showing up a couple times. There it is. It was 89. So on the mutual fund report, it says, this is my winner. Well, guess what? It's on IBD 50. It's been in and out of the stock spotlight. It's on a couple lists. It's on the IBD, or Big Cap 20.
Can you talk a little bit about the super cycle, the fiber optic, you're going to talk about it later.
Well, in this one,
Super optic cycle, what do you call that? The super
This?
cycle of optics, yeah. Momentum.
well, this is in a basing pattern. It just did an odd looking double bottom, but it's basing,
The
so
same group as Acacia, right? Acacia
Yeah.
at the bottom fell off from, it's still trying to recover, I think.
it is. But this should be on your watch list because that's been a powerful uptrend. It's completing the right side of the base, so pay attention to it. I think it's around 42.50 is where your buy point is. But look at the price where it's at. They're buying it at the market bottom. Okay? All right, and I think that was the 30-week moving average or close to it. But the semiconductors, so back in January, when you start seeing the equipment vendors from the equipment makers, KLA 10 Core, AEIS, those type of stocks, and Avago show up, and the semiconductors are moving in the top 40, I told you a powerful rally is going to happen. 2003 was the last time the A's were at this level from that breakout. The semiconductor groups were in the top 20. The three semiconductor groups are still in the top 20. They have been since March, April. There's some pretty patterns out there. Texas Instruments is broken out as part of the, it's not much, but I'm just, IPHI is got the data center servers. That's a big data. You need servers. You need to compute it. NVIDIA is part of that. IPHI is part of that. IPHI is also partnered with the stuff that Microsoft's doing with this cloud network. So that's why it's a sector leader. It's been featured all over the place. So the composite. So one of the things, this is a 21 EMA. This is an envelope around the 21 EMA of 1%. So the red lines are basically minus 1%, plus 1%. See, yesterday when everybody was crying whoop, it doesn't even come to the 1%, and now today it closes at a high. The other thing that I use is this parabolic SAR. It's basically just tells you when the trend is topping and when the trend is bottoming. I can tell you that anytime that it gets to the 21-day moving average or the upper 1% window, that's typically the end of that portion of the rally. But all you're looking for is, we talked about September. See how August we started coming under pressure, we came to the 21, made a new high, and then we had the VIX show up. There's 0.1, there's 0.2, there's 0.3. And we're below the 1% window every time. So when you see that 1% and you see it, the price action below, it's telling you, and by the way, September, this was 0.1. It told you this was not going that much higher. Okay? Look at the powerful, we go from this bottom to we're back in the channel and we're out of the channel. When you're out of that channel, you're in an uptrend. You don't need to interpret volume, you don't need to interpret distribution days, you're in an uptrend, okay? Now, the quality in uptrend is the other thing you want to ask yourself. If the count has just been to 3 and you go outside, the count on the VIX is now 0 because you made a new high. Whenever an index, and I don't care which index you follow, you look at all of them. The beauty part of this chart is all you have to do is change the name right here, and you don't have to have another chart link. It's set up for you. You don't have to pay stock charts for this service. You just have a link, a bookmark link. This is free. Stockcharts.com. And that's the, okay?
So an all-time high or it takes out an old high when it resets? Like it reset, but did it reset back in 1, 2, and 3? You see what I'm saying is,
Go.
this high is higher than the one prior.
Answer right there. There's arrow 1, new high. Because that's 1.
So
That's VEX 1.
okay.
The first rally is typically going to go outside the Bollinger Band. It's typically going to be a new high. And that's the last time you get out of Dodge. The second one sets up the double top. So when you hear people talking double tops, there's your double top formation on the second arrow. You don't get a third top. The third top comes, well, the NASDAQ at this time was the leader. So the NASDAQ's the one that's going to go up to its upper Bollinger Band. But the reason why, if you're looking at the S&P 500, the S&P fails at the 21-day, not the upper Bollinger Band. The leading index at the time is going to go to the upper Bollinger Band. The weakest one doesn't even get close to the 21-day moving average. And that's because the small caps and mid caps corrected the most. They were the ones that never got to the 21-day moving average because they corrected 12%. That was only a 5% correction. But the biotechs corrected 25%. Right? The small caps and mid caps corrected 12%. So did we have carnage? The new leadership is in the small caps, mid caps, the banks, the regional banks, the infrastructure names, the metal, the steel names, commodity type companies, oils.
I guess my point is to get to the next Y, which is the first thrust up, I have to have it go down below the 1% loss to call that a 1.
You're not using this chart at all.
I'm using VIX, right?
Right.
Okay.
VIX is basically when you're at 1, it tells you there's 2 more sell-offs coming.
Okay.
They go in sets of 3. And if you don't believe that, they go in sets of 3.
And it's the reverse for the upside too, right? 3 thrusts up, 3 thrusts down.
No.
No. Well, that's what you just did.
Not on the VIX. When you get to 1, yes, you're going to have a thrust up so that you can set up VIX arrow 2. Then you're going to have a counter move so that you can set up 3. The counter move starts when you close below the 10-day moving average. I know this is complicated, but if you guys get this figured out, you're going to make a lot of money. And it's all you have to do is look at that chart. And the blueprint, go to the next one. Here's how you set that chart up if you want to know how to fill that out. And you have the details, okay? So the next chart on the VIX. So all this is a 20% around the 10-day moving average. And every time you see a spike, typically you're going to want to see a close above the 20% window. There was a false spike back here for 1 day. But typically when you have the corrections, so September, you go flying outside the upper Bollinger Band. Okay? The subtle one doesn't, I don't think this came close to the upper Bollinger Band. And it basically just stayed there very quickly. But you also never got below the 20% window. I think this only came down 8%. And then you see how, when I say the third wave is the powerful danger, those are where your spikes are occurring. Now, Well, this was the third wave coming off the flash crash. And you guys, that was 6 painful days of selling, right? So go back to the VIX so that I can answer this question better.
Where do you go?
It's about bifoils that way. Well, all I can tell you is the S&P appears at an all-time high. Mark your chart as that being a 3.
Here's my problem is, it's always easy looking at back. Why wasn't that a 1? Why wasn't that a 1? And, you know, if it printed. I'm not-
Because that never went 20% above that 10-day moving average.
Okay, so that's.
It was,
Okay, so that's enough.
the criteria is I'm 20% above the 20-day moving average.
Okay,
All right, now you got the rest of it.
thank you. That was a missing one.
But you already were told I'm in volatility land. Spike number 1. I'm not done with volatility until I get to number 3 at a bottom. Okay? So if you're long anytime in here, you got to be long, you got to be protecting it very closely, or you can lose money very quickly. Because that could have easily gone up here, just like it did over on these. Over here. Well, they didn't go that well. That one did. The other clue of these, as long as the 10-day stays below the 50-day, rally on. That's why that wasn't a concern. Because the 10-day line's got to be near or close. But you see back here, that set of 3, the 10-day never got through the 50-day. That was resistance, which, if you're paying attention to the high-low had about 3 days of uptrend and rolled over. Basically, when you get above 0.5 on that high-low, you want to see a quick ascent to 2.0. If the follow-through day and the buying pressure is real, there's going to be buying hand over fist, short covering rallies to get going. Okay? That first phase to get to 2.0 is the short covering rally. Then you want to see it stay there. Sometimes those short covering rallies die at 1. Well, if you go to the... So is this helped or hurt?
Yeah.
We're at the 2 now, huh?
Yeah.
So you think we're gonna have clear sailing going up? And then then we'll have the first spike coming up in the future.
But right now, we're clear sailing. Let's go look at the VIX chart.
But we got the Fed announcing here.
Tomorrow's
Huh?
oil drop, would it affect the?
Fed announcing.
Oil's been dropping the last 2 days, and the rally's going on.
We get a lot of announcements in the rest of the week. We got 3 major announcements. So does everybody know what we just covered? Basically, I don't have one of these, where to find it.
Does that help, hurt?
Helps.
Pretty good. Good, right.
It helps, but the VIX takes a while to
That's
watch to
complicated. A lot of
interpret.
work, yeah.
Because it's the
If
same
you
verse,
watch
you
it,
know,
but
same verse.
like I said, if you watch the New York and the NASDAQ, number of new highs and new lows, I always used to look at that in the paper. The new lows, when those are low, we're going to be in or out. And that's pretty simple. But if you watch that number every day, I used to write them down. I haven't been writing them down because they used to be easy to find in the paper. Now you got to do about 3 clicks on the website to get to. So
You want to see those numbers for the last 2 months? Here they are.
Yeah, he's got them all wrote. He's way more technical than I am. So that's all I ever worry
So it's
about.
like 2 to 3 times more than,
Right, 2 to 3,
Yeah.
about 3 times.
3 times more.
And as long as
those
that-
are the same numbers I'm clocking, but I use FinViz.